Welcome to Views from the Top. I'm Hansley from Live Wire Markets, and joining me today is Pete Robinson, the Head of Investment Strategy at Challenger Investment Management. Great to see you, Pete. Thanks for joining us.
Thanks for having me.
You know, it's funny because I last spoke to you nearly a year ago, and apparently a year is now an eternity in financial markets. I kind of want to draw about some stuff from what you said last year, and obviously we'll pass it into this year. So you mentioned that you were relatively bearish on the outlook, you were concerned about a cash rate with a 5 handle, and maybe that the Goldilocks period for fixed income had not started. Well, let's take a look at what's happened in that time, and we'll put up this this table for you all to have a look at if you're reading or if you're watching the video. Because in that time, cash rate has increased, but it's still got a 4 handle for now. And the Australian 10-year yield is up something like 90 basis points in that time, and we've also put in corporate bonds there as a reference to that. So, with that in mind, first 2 questions reference last year to this year. Are you still relatively bearish on the outlook? And has the Goldilocks period for fixed income started yet?
Yeah, I mean, we don't try to make calls on the direction of rates, but I think I'm still concerned about what higher rates means for the wider economy. I think that view that we had a year ago still holds true, just the impact of higher interest rates. And I think we liken it to, we've been talking to people a lot recently about the pig and the python. Like the python takes a long time to digest the pig, it takes a long time for the impact of higher interest rates to pass through the wider economy. And in fact, Stepstone had some really interesting research that came out a week or so ago talking about commercial real estate markets, and they highlighted in the GFC, it wasn't until 3 years after the peak of the market that they really started to see properties turn over. So the peak pain was felt a long time after the stimulus impact, you know, that led to the pain was initially started. So I think we still hold that moderately sort of bearish view, as that higher rates is the downside scenario that markets should be worried about. I think some of the recent price action has borne that out, and the market sort of shares that view. I think the thing that we probably, you know, we understated was we thought it would take less time to pass through the python. The pig would move more swiftly through the python, and what we found is that the lagged effects of stimulus have had a much longer half-life than we expected, and generally people have been much more resilient than we expected, and that's what's leading to the upwards pressure that we're seeing in rates markets right now.
All right, well, we'll come back to the upwards pressure in rates markets in a little bit, but obviously we started this year markets predicting possibly 7 rate cuts from the Fed. Now it's 1, and even that's looking shaky. And obviously those quantum of rate cuts now, you know, potentially not coming to fruition. I'm curious, where do you actually sit on that debate?
I'm not trying to say I think that it's my base case that we're going to get higher rates, but I am concerned that if we do have higher rates, it is going to weigh on the economy. The longer that rates are higher, and I think I probably talked about this last time, it's not even about where we are, it's about how long we are in the ballpark of the current level of interest rates, because already the current level of interest rates is constraining for certain parts of the market. And so it's how long, and I think that's what the stimulus last year, it wasn't so much that rates changed, because, you know, we've had a big move in sort of longer term rates from, say, Q3 through to Q1 of this year, but the sentiment shifted, right? So people started to have a more positive sentiment, asset prices, inflation, and that was stimulatory for the economy. So that was a form of easing in and of itself, and now more recently we're effectively getting the opposite, which is tightening as people reset expectations. And, you know, maybe it's that person looking to buy the investment property who says, well, no, actually now I feel like rates may stay up where they are for longer, and I'm going to hold back. And so that's effectively a form of tightening. Add to that what we've got in the second half of the year. We've still got conflicts in Russia and Ukraine, and obviously Israel and Palestine. We've also got the elections in the US, and, you know, if Trump wins the election, there's an expectation that some of the actions that he'll take, you know, around trade will be inflationary. So yeah, I think it's a pretty uncertain outlook, but definitely my concern is still if rates head higher from here or stay where they are.
Yeah, so I was about to ask you a question about whether you think we'll even see the one cut, but maybe, you know, even if we get one cut, that's not really going to be a big impact, and the and the actual question should really still be whether there's upside to higher for longer. Is that what you're saying?
I wouldn't call it upside. I think what's ultimately going to happen is the longer things are easy, the worse the medicine's going to be when we eventually have to take it, and we will have to take it at some point.
But coming back to the RBA, it has become less hawkish in recent months. But kind of passing what you're saying there as well, and what you're saying around the effect on the economy, I'm curious, do you think they can really afford to be this dovish, or at least this less hawkish, given how sticky inflation has become in Australia?
Yeah, I mean, the last few years we've had this really interesting phenomenon where the real economy has had really starkly different views to the central bank. And I think part of that comes down to how narrowly the central bank has defined its mandate, as to price stability and full employment. Whereas you and I sit here and we look at what's going on, we look at the levels of immigration and how that's driving inflation, particularly in the housing market. We look at what's going on in the commercial real estate sector, particularly in the US, in the office sector, where vacancy rates are 20%, and we've got really significant levels of arrears, and 70 to 80% of loans in office CMBS are getting extended, so they can't be refinanced because of the level of interest rates, because of the challenges around serviceability. So we're seeing that. And we're crying out, but the central banks have this narrow mandate. Now, I think the RBA reforms were good in that respect, but it's still probably just a bit too early to see whether that shifts their thinking around their broader mandate.
Okay, so let's pass through all this then. Given what you've said, and given how you are concerned about how these higher rates will affect the economy, where in the fixed income stack are you then investing?
Yeah, so we focus exclusively on credit markets, so we're not really taking views on government bonds. So within the credit space, where we're seeing value is in private markets below investment grade. We still see an outsized illiquidity premium. So the return for taking on liquidity risk for going into those private markets is elevated. Now, to be fair, that's at least in some part due to the fact that public markets have rallied so strongly. So if you look at US high yield markets, for instance, they might have rallied 150 basis points from the sort of wides of Q3. Private markets probably only widened by 50 to 75 basis points. And so that's what's driving that relativity. Away from that, in public markets, the investment grade part of the stack, we think represents better value. It hasn't tightened as much as high yield. It's really been an extraordinary rally in like the double B part of the curve that we've seen in spread terms, and so that strikes us as somewhat expensive. Okay,
fair enough. Coming back to what you were saying about real estate there, obviously you've already alluded to this, we haven't seen that material downturn in house prices that many expected. Immigration's one of them, like building another, so on. So I'm curious, we'll talk residential, then we'll talk commercial, but within residential, do you think the full effect of rate hikes has already passed, and that the next move for house prices is actually up?
No, I don't. I think that, look, I don't know where house prices are going.
Sure, of course.
Upwards or downwards, but I certainly don't think the full effect of rate hikes is behind us. I think the longer the rates stay where they are, every month you've got a paycheck, your savings rate's going down, your discretionary spend has to change because you've got to permanently allocate, or at least for the foreseeable future, allocate a much greater share of your income towards paying your rent. We have had strong rental inflation, in part due to the migration that we've seen, and also due to household formation rates as well. One of the big things that happened during COVID was that household sizes shrunk sharply. That in itself was a form of net added demand. And so what we've seen is, that's bottomed out effectively. So vacancy rates, if you look at SQM data, vacancy rates actually haven't gone further down from here. They've sort of flatlined at very, very low levels, but flatlined. So I think what we'll start to see as housing gets more and more expensive is household sizes will increase, and we'll get a natural correcting mechanism there. we actually had overnight, the UK came out and announced curbs to migration. We've had talk around student numbers declining here as well. So we may be passing the peak on that migration side as well, which has been really the number one driver of stimulus. And then who knows, maybe the government, whichever government it is, can find an answer at a state or federal level for the housing supply issue as well. I don't hold any big hopes out for that, but if that issue can be solved, obviously that has a huge impact as well.
We thought we'd close the interview with this. Views from the Top is Livewire series dedicated to putting people like Pete and people in Pete's position to talk about things that they've learned in their investment careers. You've obviously been doing this a while, a little while at least, certainly.
Yeah.
What is one thing you have become privy to recently? Can be an insight, can be a philosophy, piece of information, whatever it is. What's one thing you've become privy to that you wouldn't have realized or had access to if it weren't for the position that you're in today? Indeed, do you have a view from the top?
I would say it's not so much about where I sit, and I think that's a really important thing. You know, being in the position that I'm in, you know, means I get to talk to a lot of people and hear a lot of things, but I think the insights can come from anywhere. And in fact, for me, one of the biggest insights I've had more recently, it's taken me a long time to learn this one, has come from my kids. And it's about sort of the rewards for effort, and how much you can achieve when you put real focused, detailed effort into something. And I think a lot of time, we spend a lot of our time, and particularly in our office careers, spinning the wheels a little bit. And it's not focused effort, it's not focused attention, it's not focused in terms of trying to solve a problem or address an issue. You know, there's a great book about this that I was recommended called Bounce by Matthew Syed. It's not new, but it really talks about this in sport, as how, you know, real focused efforts, kind of like the 10,000 hour rule, can lead to great things. And so for me, professionally, that's what I try to do. Every quarter we write a piece where we really go deep into the markets in which we operate. It's our sort of what we're watching piece. And to me, I spend a lot of time on that, and the thing for me is focused effort on it, really being focused and dedicated to that task. And I think we get better outcomes as a result.
All starts in the home. Pete Robinson, thanks for joining us.
Thanks, Hans.
And thank you for joining us. If you enjoyed that interview, please subscribe to the Livewire Market Index websites as well as our YouTube channel. Thank you for watching.